I'm going to teach you how mortgage rates actually work in about 60 seconds while I'm pumping gas. Most people get this wrong because they're listening to the wrong headlines. If you've ever wondered why the rate you see on the news is lower than the one that your bank quoted you, here's the real reason why. First, let's clear up the biggest misconception. The federal government does not set mortgage rates. When you hear that the Fed has raised rates, all that means is that they've adjusted the cost for banks to lend to each other. It is a ripple effect, but it's not a direct command. Uncle Sam
Okay.
isn't picking your interest rate,
Mhm.
the market is. There's a massive global market where investors buy and sell what's called mortgage-backed securities. Just like a stock, the price of a mortgage goes up and down every single day based on inflation. If investors feel like the economy is getting shaky, they demand a higher return. That's why rates tend to move up and down with the 10-year Treasury yield. If the yield goes up, your rates go up. If the yield goes down, your rates go down. Now, here's why your quote might look different than the TV ads, and that's because those are usually for unicorn borrowers. They're usually for like perfect 800 credit scores, 25% down payment, and zero debt. Now, reality is that not everyone is a unicorn, and that's okay. You don't need to be perfect to buy a home. You just need to know realistic numbers for your actual circumstances. Your credit score and your down payment are more like your personal adjusters. The market sets the floor, but your financial circumstances more determine where you land. So I just don't want you to be discouraged by teaser rates that you see online. You focus on the variables that you can control, like your credit score and your debt. Get a quote that's based on your real life and not some fantasy. At the end of the day, a realistic plan is better than a unicorn dream.